Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about STEM as they've recently released a new presentation as of today. However, the stock dropped more than 7% at some points in time today, ultimately closing out the day at 6.8% down. Now, this is stock that the last video we did was actually based on their last earnings, where they announced quite good earnings. Again, they showed net income positive as a result of some accounting changes to how they were recognizing debt, but overall, from a revenue perspective, they came in on the high side there, and the stock popped as a result. I mean, if you look at the year-to-date numbers right here, it's been a rough year, but what I would highlight is their earnings originally went up. That was following a somewhat down week, and since earnings, the stock has come back down to where it was earlier this year in the early part of May and into June. Again, we haven't seen the stock at levels we've seen today since that point in time, despite the fact that the company continues to perform pretty well. Again, there hasn't been any additional news for the stock. You can see a number of their estimates and the information here. However, for today, one of the things that really dropped the stock right from the get-go was this Morgan Stanley downgrade. They are lowering that price target from $12 to $8 here and changing it from an overweight to equal weight. So this is not saying it's a good, bad, or ugly stock, but rather that this is something that they're not necessarily going to target that same level that they were previously. And again, that was primarily going to be associated with the income and the lack of pushing towards overall profitability for this calendar year. Now, this is something that, again, they had the CFO talk today, they had the CEO on, and their conversation was primarily going to be associated with essentially, are they going to be able to deliver on some of the things that they've talked about? And you can see total revenue continues to trend very, very well, especially if we're looking at this on an annual basis. Again, they've only been a publicly reporting company for 2 years. That is massive revenue growth. And as you can see, if I look at the quarterly view, they are on pace to break that, with their big quarters being in Q3 and Q4 of this calendar year. However, the big concern there is always going to be on that income side. Again, this is a skewed number, as quite a bit of that net income for the past quarter is associated with the recognition of a change in their debt. But the company has been burning money over the past 4 quarters, and that is set to change in this quarter. Now, at this point in time, I want to take you to the presentation that they released so that we can talk about that and talk about some of the reaffirmation of profitability this calendar year, as well as some insight into how their sales are being broken out. So what I'm showing here on the screen is the same presentation that the CFO of STEM presented today at a Barclays conference. It is available on their website. I'll put that in the link down in the description down below. If you're watching this in the future, there may be additional presentations that have been released since this point in time. A lot of this material is going to be reflective of their Q2 results. Again, revenue up, bookings up, backlog up, contracted annual recurring revenue. All the things that we like to see were going up. They continue to execute, recognizing that the latter half of the year is going to be the big time to deliver on this. I think that we'll continue to see a lot of moving parts. However, things bode well. So what I would highlight is we kind of go through the projects down here. They showcase their growth, the expectations for this calendar year. Again, targeting that $600 million in revenue. Bookings, this should be a comfortable $1 billion year, as was last year. In 2023, they're looking for that 15% plus margin on the GAAP basis. At this point in time, we're around 12%. Again, company continuing to perform very, very well. What I would highlight is within this presentation, again, there was a lot of new info in here, but I want to showcase a few things that I think are super important. The first one is this revenue build, talking about how they recognize revenue and where the gross margin is going to come from. Because gross margins have continued to stay very, very low, we do recognize that they are that reseller, that installer of the storage hardware. So because of that, this is where we're showing some of those large leaps upward in revenue, and that we're not seeing that same trend of profitability. However, a number of these projects that are going into place this year are going to turn from just software, or rather just storage, to also include those software pieces, that SaaS piece, where we have those 80% margins, as opposed to the 5 to 15% you're going to see in those larger projects that you see there. So what this means is we've got this breakout. I think that this is great that they're finally showing this level of detail. This is super beneficial. They are growing revenue like crazy, and we can point to the fact that a lot of that is coming down from that storage hardware. If we scroll down below, one of the things that we have the capability to do now, and again, this is a chart that they've never provided to us before, but we're able to see that supplemental revenue detail showcasing where that money is coming from. I'm going to primarily focus on the 6 months ended, again, because this is the first time they're showing this information. This total solar revenue that you're seeing right here, about 33 million, this is coming from their acquisition of Also Energy that happened as of last year. And you can see that, again, that's around 33.5 million. That's reflective of those 2022 numbers. So that is going to be somewhat lower than what we're expecting to see for the majority of this calendar year. But what I would highlight is for this information right here, that 33.5, that's total solar revenue. If we expect that to increase at a little bit more than double, we can comfortably assume around 70 million in that solar revenue, which if we're going up above, again, that solar hardware, 40% gross margins, and any software associated with that is going to be 80%. So overall, the solar side, if we're looking at solar revenue of around 70 million, we're expecting quite a bit of margin play from that solar revenue. So the point that we're going to have to focus on is going to be the revenue detail over here, where that hardware is coming into play. At this point in time, that service revenue, again, the software is going to be that 80% gross margin. That's only about 28 million. The project service, which is still pretty high margin, only about another 3 million. So that means if we assume kind of the overall breakout of the total look and view and feel is that between these two numbers right here, we're still talking for the first 6 months, we're around 64, I can be conservative and say 65 million total revenue. That is backed up against the total of 160 million that you see here, which showcases why we've got that low GAAP gross profit of about 13 million. And that means that most of this revenue recognition here is going to be coming from the hardware side, in particular the storage hardware, which is mostly going to be batteries and the information associated with that. The question is, after they're delivering on these projects, do we begin to continue to recognize some of that professional service information as well as the SaaS side with the Athena platform? So those items right here are really going to be what drive the capability to achieve profitability. Because they've achieved or delivered on another $100 million, and again, these are all estimates, this is my opinion, you should not take this as investing advice. I'm just some guy on YouTube. What I am highlighting here is, again, we've got that large increase in what I'm assuming to be is that storage on that delivery side, that hopefully they're going to be able to leverage a lot of that and recognize that revenue here in the second half of the year to get quite a bit or millions of dollars to profitability. Because again, this year they're saying that they are expecting to be adjusted EBITDA positive in the second half of 2023. So what does that look like? Again, they were on a call today. Today is September 6th of 2023. And when they asked about the capability or how confident are you of hitting EBITDA positive this second half of the year, the response from the CFO was that he was very confident. So it is September 6th. The reason I highlight that is that means 2 months are already gone by in terms of hitting these revenue goals, and that means the profitability goals right here. Again, this is the 2023 full year, negative 35 on the low end. And if we scroll down below here again for that revenue detail, you can see that we've already had that adjusted EBITDA, a lot of wiggle room if we err on the high side there. Now things change in business, but what I would highlight here is if we're 2 months in, that means that they've got to have reasonable line of sight to saying these numbers should be looking pretty good for the third quarter. And that's going to lead me to believe that they're going to continue a trend that they've had over a number of quarters. Is Q1 through Q3 over the past 2 years, they've consistently hit those numbers. They've been on the high side of these estimates, and then they've dropped the ball due to the projects getting pushed in Q4. So the question is this year going to be when we see that change? Overall, I think through what I've just highlighted, that I think we're trending very positively for Q3 2023. And if there is a clear path to profitability, that will bode well for Q4 and the company as a whole. Another thing that came about as a conversation today, and something I think is super important to note, is the overall cash balances associated with the company. So they have a very low cash and cash equivalents balance beginning or at the end of the second quarter. This is something that they highlighted, that the primary reason for that is because they purchased all of the hardware that they were expecting to deliver on all 2023 projects. Historically, this hasn't been how they've operated. However, I'm assuming it was because they got good deals. It made sense. They could cover their projects. And as I mentioned previously, they're expecting a lot of those hardware sales and the delivery of that product to convert to revenue as well as software revenue in the second half of this calendar year. So the stuff they delivered on in the first half is going to go hopefully towards some level of software, and the hardware they're delivering or that they purchased is going to be delivered upon in the second half of this calendar year. As such, between that and a pull on the higher accounts receivable, the expectation is they are going to increase with higher levels of cash, meaning that there is at this point in time no expectation of having to raise additional funds at this point in time. Again, they've done a deal restructure or a debt restructure to have access to additional cash earlier this calendar year, and we shouldn't expect to see that type of volatility in the ARs on a go-forward basis. So between the working capital conversation here and the additional clarity in how they're getting and achieving revenue, where those margins come from, I thought that this investor presentation is probably the best one they've released year to date. And in alignment with that, there's a significant amount of information within the product or within the presentation that showcases quite a bit of the detail in here. Because of that, one of the things that I would highlight is from an overall growth perspective, they continue to hit their numbers. Things are looking very, very good. The things that I want to focus on at the next earnings call, and we'll do a earnings preview at that point in time, is this backlog increasing because they're supposed to be delivering a very strong revenue number this quarter? Is the backlog going to increase? Are we going to see that assets under management increasing? Is the overall CAR going to be increasing? Again, that's a metric they provided. But the main thing is I would love to see them hold these levels, again, that 13%, that 18%. Love to see them hold or exceed the numbers that you see right here for the third quarter with that increase in the revenue expectation, which will primarily be hardware, but hopefully we'll start seeing some of that profitability come up as well. So there's a lot of moving parts within here, a lot of information that we've seen previously, but overall I think that this points to strong performance for STEM going forward. However, we're going to have to see them, as expected, deliver on these projections for this to really mean or be meaningful in a way that they can deliver in a strong way going forward, and we can see that appreciation in stock price. Once again, I am clearly just someone on YouTube, so don't take this as investing advice. But if you have any thoughts, questions, or feedback, please let me know in the comment section down below. Thanks. Talk to you later.